Testing 1 2 1 2. Good evening.
Good evening.
Good evening. How's everybody? Are we good? Are we
All
good?
God is
good.
good. God is good. We are all good.
Great stuff. Great stuff. Great stuff. Great stuff. Now let's get into it. Apparently apparently there's a scheduled power outage at 8 p.m. my time, South African time, which is basically, let's see, an hour 15 minutes, I think, from now. So let's try and get in as much as possible. Let's start with the usual questions or comments, if any.
Yeah, good evening, Lebo.
Good evening, say.
Yeah, I wanted to ask this yesterday. I thought someone was going to bring it up, but nobody did.
Uh-huh.
And yesterday I was kind of like I told you, my Tuesdays and
Yeah,
Thursdays.
I remember.
Yeah.
Mm-hmm.
So I don't know, the elephant in the room, the CPI tomorrow. We did justice to NFP last week. So is
100%.
there a similar thing to guess the direction of the CPI tomorrow? Like, are there data we could look like to like forecast what is going to happen with the CPI data tomorrow
Yeah,
as well?
yeah. Now, let's have a look, see. Let me bring in Forex Factory and look at what are the economists predicting and what did we get in the last couple of months. What is the general trend there? Let's see. Forex Factory. Great question, by the way. We do have CPI, and I think we understand how important it is in terms of monetary policy. It definitely does play a significant role in informing those members what to do with their monetary policy. By the way, what is the Fed's mandate? Remember, they have a dual mandate. They're always looking at two things. They are mandated to regulating two things. What are those?
Price stability and employment.
Price stability. Mm-hmm.
And
And what's that one?
Max,
I beg your pardon?
employment.
Employment. Price stability and employment. That's correct indeed. So when we speak about price stability, we are basically talking about inflation, right? And what is the target for that inflation? Where would I like to see it play about?
2%.
2%.
2% indeed, right? Does anybody know what the current inflation rate is?
2.2.
2.2? Let's see.
Yeah, I think.
No.
No? Okay.
Okay.
That's
Where are we sitting?
2.5 or 2.5. Yep.
2.5. Okay. All right. Okay. I'm just sorry. You might be wondering why am I a little slow. I'm just getting everybody into the session here. The quickest way for me to find that inflation rate is just to go to the Trading Economics homepage and scroll down to those important macro and find it here. 2.5 is where we are currently.
Okay.
Right. So we're not too far off from the target of 2, but already they've cut interest rates, right? And I said they don't have to wait for it to get to 2%. In fact, they don't wait for it to get to 2%. It's like accelerating when you can see the stop sign ahead. Right? So that is basically what they're doing because they know monetary policy is lagging by it lags by nature. It takes about 18 to I think 24 months to actually start seeing those monetary policy effects. So they wouldn't want to overdo it and basically undershoot their target of 2% because then they will have another different kind of problem on their hands. So far, we've already seen that 50 basis points cut. Now, tomorrow, we have inflation data coming up. Tomorrow is, let me just change this view here. Why does it look different today? Let's see. Tomorrow. There we go. Two main important things. inflation, and unemployment claims, which we get weekly. But of course, the center stage tomorrow is on inflation, if anything. And the core inflation numbers will definitely be more important than any other. When I say any other, I'm talking about excuse me, headline inflation. So we've got headline inflation and then we've got core. Okay, so let us see. Year on year, 2.5 we've seen. There is a focus of 2.3, which is a contraction, in line with the 2% objective. Let me just do this. There's a bit of background noise. I'll just mute you. If there's any question, you can just ask. Yeah, so 2.3%, will we get it? Nobody knows. But of course, like I always say, if we indeed get the 2.3% or even better than that, in other words, lower than 2.3%, that we stand a chance to see an overreaction in the market. That's where we can engage that data upon its release. Does that make sense? That's where we are likely going to enjoy clear price action, if I can put it that way. Now, should that come out indeed, let's say 2.2 or 2.3, fine. Let's say we get 2.3, because at the end of the day, it will be a reduction from 2.5, and quite a significant one for that matter. What do you want to do with the dollar? What do you want to do on the charts? Whatever chart that you're looking at.
You mean if the data come out below 2.3?
Yeah, let's say it comes out below 2.3. Let's say it's 2.2.
You want to sell the dollar, obviously.
Definitely sell the dollar, right? Definitely sell the
Yeah.
dollar. All in agreement?
Can you explain that level? If the inflation is lower, what does that mean?
When you have lower inflation, it definitely, well, let me put it this way. It will indicate two things. Number one, we use inflation to measure economic activity as well, remember? So a lower print on inflation signals a slowdown in the economy.
Yeah, activities, yeah.
Right? Now, it's all about, of course, context, right? Why will the dollar also maybe be selling if that data indeed comes out, let's say 2.2? As a matter of fact, the lower the number, let me put it this way, the lower that number is, the more selling we will definitely see on the dollar. Now, this is the market pricing in the possibility of the Fed, the FOMC, cutting interest rates by a bigger chunk, just like they did 3 weeks ago, 2 weeks ago. Is it making sense?
Yep, it does.
Okay. Medino?
Mr. Lebza,
Yes, yes, yes.
please, I want to maybe bring an input on the question.
Okay.
In terms of, I really would like you to just delve a little bit much on this one, because remember you told us, which we saw, that the interest rate target is around 2.2. So on a general sense, is that if they cut and they get to maybe 2.2 or whatever, 2.3 as the forecast for the economies are projected, according to how I see here, it means they're getting closer to the target. Why now is the dollar going to sell instead of gaining strength?
Okay. let me put it one more time. Give me a sec. Just rearranging some things here. Okay. Sorry about that. Oh, let me just get other members into the session here.
Oh, these things are confusing, eh?
No,
I
Yeah,
You think
Not
you
a,
think you think you understand, and then boom, you start being really confused.
no,
Inflammation.
no. Don't be, don't be,
Yeah.
don't be. Do not
start
dismay. I am here. Let's
continue
click here.
start.
You know why? There's a reason why I actually use Forex Factory for you, right? Remember, I said it's arguably a very easy user interface to navigate. And these folders here help quite a lot, actually, because they give you an idea of how you should understand that data or engage it. Okay, so let's click on it here. What we want to see is what is the usual effect on this data. So they say actual or greater than the forecast is good for the currency. Actual or greater than the forecast is good for the currency.
Okay.
Not so long ago, I said, if inflation prints lower, it signals that the economy is doing what? Speeding up or slowing down?
Slowing down.
Slowing down.
Slowing down. Great. Naturally, if the economy is slowing down, as an investor who holds bonds or that particular currency, in this instance, the dollar, does this give you greater confidence or less confidence in that economy?
Less confidence.
Less.
Right? Basic economics. So you would want to disinvest in that particular portfolio, whether it's bonds or the actual currency itself. Right? So we were saying, if we move from 2.5 to 2.2, which is even lower than the forecast and even lower than the previous number of 2.5, it's quite a big contraction. That's where you're going to see definitely an overreaction in the market. This is where you're going to see the dollar sell by quite a bit. Right? That I want you to understand. I'm not adding any other layer onto that. Right? Now, given if we get 2.3 tomorrow, it's still a contraction. When you compare apples with apples, what was the previous? In other words, what was last month's reading, which is 2.5, compared to
2.5.
tomorrow, and we get it at 2.3, it's definitely a contraction. It's definitely a contraction. It would have met, economist expectations, and definitely we will see a negative reaction on the dollar. No doubt.
No, it's clear.
Now,
Clear. Thanks.
okay, here's another layer to it now. Remember I said with NFP, it can be a little tricky to engage this type of data or data, broadly speaking, when it comes to the US stock market, right? We said with NFP last week, when we did a review yesterday, we said it showed that there was a rebound in the labor force. And the ISM data also showed that, which is the ISM services data, which is the largest sector of the US economy, showed a lot of resilience and actually printing 54 point something, which is definitely in an expansion territory. Now, indeed, labor data came out quite good last week. You want to buy the dollar. Now, as an investor as well, you always have options. If you don't want to invest in the dollar, in other words, the stock market, in other words, the bonds market, which is the safest, arguably the safest investment vehicle, but also one that does not yield exponential returns, you have options. You can go and invest in stocks, right? But then when you get such data on the day and you have those options, do I invest in the currency / bonds, or do I invest in the stock market? This is where it can be tricky at that moment. Remember I said data just gives you volatility in most cases, right? Because the understanding is that based on the correlation, the historical correlation is that when the dollar sells, stocks go up. When the dollar buys, stocks go down. So why would I want to sell stocks on such great data that signals or reflects a healthy economy, right? So that's where the confusion may be, right? So CPI tomorrow coming out lower. CPI coming out tomorrow lower, let's say 2.5 to 2.3, or say 2.2. We've already established that we want to sell the dollar. So if we're selling the dollar, what do we do to the stock market? Do we buy it?
Yeah, naturally.
You see, naturally you would want to click on buy. But you may also see actually the stock market tomorrow also take a dip. In other words, being positively correlated to the dollar.
Yeah.
So in my advice or my suggestion, because I'm not authorized to give you advice before you take me to court, is to maybe opt for cash when it comes to investing on the stock market. In other words, maybe don't engage the stock market, those charts, maybe leave them alone. But if you do trade, or you have a trade plan that you want to execute based on this data, as long as you understand that the risk exposure is slightly greater, right? At least for the first hour or so, the dust needs to settle first, then you can engage those charts, right? But essentially, having a lower CPI number tomorrow will definitely signify that the economy is slowing down. Okay? That the economy is slowing down. But then, because we are smart people, we understand that if inflation is coming down, we already start we start to speculate on what the central bank is likely going to do. And like I always say, the market is forward-looking, and so we priced it in. Right? So if we do get a lower print on inflation tomorrow, the dollar selling, you may actually indeed see the stock market buy. Why? The stock market buys not because the data is bad. Oh, it's so bad we must just buy. No, they're not. It's not a celebration in that sense. No, it's the intelligent people like you and I already speculating on what the central bank is likely going to do, because they're looking at the same data. So we start to say, okay, hang on. If inflation is printing lower and we've already had our first interest rate cut, this inflation is moving in alignment with the Fed's mandate of getting inflation back down to 2%, right? So that means there's a likelihood that the Fed, the central bank, will likely give us definitely another interest rate cut. What does an interest rate cut mean to you as a trader or investor? It means that the Fed is becoming more accommodative. They are they are in expansion territory or mode. Let me put it that way. They are increasing the money supply in the economy. In other words, they are initiating a speed up in the economic wheel. Is it making sense?
So they're encouraging the consumers to spend.
That line is not clear. Try again.
They're encouraging the consumer to spend.
Yes. You lower interest rates. Remember,
Yeah.
the economic setup is one of credit. So you cut interest rates, you're essentially encouraging spending and discouraging saving. That money needs to, no normal economy anyway, or government will encourage savings. It doesn't make sense. If everybody got good at saving, like I always say, then the economic wheel won't turn, right? And that means they too, as government, can make revenue through taxes because you're not spending. Because they need to do for earning a living, and they need to tax you every time you spend, right? And wherever you're spending your money, whatever business you're supporting, that business too gets taxed. The employees of that business too get taxed. And so when it goes, that's how they build revenue. So everybody's good at saving. Nobody goes out to their local Spur or La Parada restaurant or whatever it may be. Businesses start to die. You follow?
Yeah.
Hmm.
So this is a vicious cycle, basically. That's what it is.
Yes, it is.
It's a vicious cycle.
It's one big song on replay.
When you spend too much, the inflation goes up. So they must make you stop spending. It's quite
Yes,
interesting.
right?
It's very interesting. Yeah.
Some
Yeah,
saying maybe they're not hearing me. Is that correct? How's the audio for everybody?
I can hear. I don't know about others.
Okay, already. My end, at my end. Okay, thank you.
Oh, it's sorted. Okay. Yeah, 100%, right? So economy speeds up. So they're always trying to regulate the speed, it's yeah, let's put it that way. Let me not make too many
Okay,
examples.
regulate the speed.
Yeah,
Okay, that's the
yeah,
correct term. Yeah, regulate.
yeah, the
Regulate
economic
the speed.
speed, right? So
One more.
yeah, is there any other question?
Yeah. So is it when we looked at the unemployment claims in the last couple of 4 weeks,
Yes,
so it's declining. In
yeah,
other words, people are gaining jobs. In other words, they are as in spending is kind of increased,
uh-huh.
and we also saw that with the number of opening of jobs. So is it right for someone to say that that is actually increasing spending? That is, spending has increased between this period because a lot of people have gotten jobs and they have they are being paid, and then that has like giving them more fun to like spend and such, even
Yeah,
if not reduced at all. Is it
no,
right to like
yeah,
that argument?
I fully understand your question, right? Um, Now, jobs opening for me merely, how I understand it is that these are available jobs, right? These are available jobs out there. Now, in terms of what you're saying, we should then look at what should be concerning or what we can tie up or correlate directly to inflation. It's definitely that um, unemployment number and the jobs created, I guess, um, for the previous month. So we saw definitely unemployment move from, I think, 4.3 to 4. No, it's a 4.2, 4.2 to 4.1, 4.2 to 4.1, right? So definitely more, we can say from, yeah, like you say, from month to month, definitely more jobs have been created. There are jobs, more jobs available in the marketplace. And this definitely could mean that, oh, definitely not even could. It definitely does mean that we have um, more people in employment, therefore more money in circulation. That's 100% correct. That understanding is perfect. I don't want to distort it in any way. If there's anything then I should add is that inflation isn't always necessarily brought about by a very low unemployment number or a very strong labor force, right? How inflation really comes about or becomes a concern is when the demand for those goods and services cannot be met, right? It is when the demand for those goods and services cannot be met. So, in other words, if there's 10 of us here and we all want a pair of Nike shoes, but there's only say 5 pairs, the price of those Nike shoes then will definitely skyrocket because there's not enough supply to meet demand.
Okay.
Yeah. Okay.
Make sense?
Okay. Yeah. Yeah.
So like I said, there are many economic models out there that we have studied in the past. And the most common one is the Phillips curve, which talks about the relationship between employment and inflation. And you do see inconsistencies over the years with that economic model and many others out there. I will share that Phillips curve one with you as well, that economic model for you to look at. It's quite straightforward. But yeah, that's how inflation comes about when you have supply unable to meet the demand, then inflation pops up.
Okay.
And this is basically why we had such a high inflation rate in many countries back in 2020 to 2022. Because remember, we had a global synchronized shutdown of economies. Nothing was going in, nothing was going out. So international trade was definitely disrupted. But as the rollout of this vaccine, gained traction and economies started reopening, there was a huge backlog because a lot of people had money and they've been ordering and ordering and ordering online, right? And the labor force was not there to fill those orders, right? Somebody's ordering a bedroom unit, right? Headboard and all of that stuff. It's made out of nice wood, whatever it is. Nobody's in that factory to make it. The orders are piling up, right? Or there are people in that factory, but it's not a full staff complement. That factory normally runs with 100 employees, but it's running with 40. And these 40 are meant to do all those orders. Now, think about it logically. If you're one of those employees working in that factory, now you're doing work that is usually done by what? 3, 4 people, and you're doing it alone. What are you going to demand? Or what do you think you need or want from your employer? Don't you know? I would know. I'm doing work with.
Salary increase.
Exactly. Hey, guys, wouldn't you? That's the first thing. I've worked for, don't be shy about it, right? You want the increase. You want the increase because that is one of the biggest motivator for you to keep on doing what you need to do. Compensate me and I'll keep on working. Right? So indeed, your employer says, yeah, no, you're not, we're gonna have to definitely increase your salary. So they do it, and they do it. So when they do it, when they increase your salary, they don't absorb that cost. They redirect that cost of labor to the consumer. So the end product basically increases in price. Do you see how now this inflation got out of hand? A lot of money in circulation, not enough supply to meet that demand. Yeah. So hopefully we've done that one justice.
Yep.
And so let us see if indeed we will get a decrease in inflation. That is something that has been happening. Hopefully we can continue to the downside. We also have, of course, month-on-month core 0.3 to 0.2. This basically, when we speak about core, it's inflation measures excluding food and energy prices. That is the central or most central banks' favorite measure of inflation because it is apparently less volatile, that data, right? So they're expecting that also to move from 0.3 to 0.2. And then the headline month to month, which is the one that includes food and energy prices, that too, we expect it to come down 0.2 to 0.1. So overall, there's a broad expectation that inflation will come down, right? Unemployment claims last week was 225. We saw an increase. Now we're expecting yet another increase of 231, right? So, of course, if we have more people claiming for unemployment checks this week, that's not good. We may see the dollar sell off. Now, coupling it with, because it's all coming out at the same time. So if indeed we see a decline, broadly speaking, on most of these or all, a decline on CPI, that's a sell on the dollar, and an increase in unemployment claims, that too is negative for the dollar. So we will definitely overall see a bearish dollar. Nice and clear? Nice and easy? Lemon squeeze?
Yep.
That's
But this one,
Uh-huh.
this one's not possible to front run it, eh? Because the dollar
you can
has been
pretty much
buying.
front run anything. You can front run it on that assumption or prediction that it
Okay.
has been playing
Okay.
out month on month like this, and
Okay.
you suspect it will, come out lower. And so if what you anticipate is in alignment with also the technical side of things, and you can find that,
Okay.
perfect,
Yeah.
you're already in it,
Okay.
right?
Okay.
You're already in
Yeah.
it. Perfect.
Yeah. Okay.
We had a trade plan on Nasdaq, which is a nice profit. Well, last time I checked, hopefully we didn't get stopped out. Let's see. Where's the trade? Let's see.
Almost at CP.
What is this thing? I'm trying to figure out. By the way, I got a new phone. But I was bought a new phone. I said I've had to buy such things. So hopefully I'll get a laptop. I'll continue hinting to the missus.
I think you hint more at an iPad.
Yeah, I want the what's that? A book what Pro. I did hint it.
MacBook Air.
Yeah, it's very nice. I like what it does, but I just can't part with that. No, not me personally. It's not gonna work out. Okay, where is the drawing? Where are the drawings for our Nasdaq? Because I know we definitely had a plan on Nasdaq. There we go. Almost hit TP actually. That bullish momentum still seems to be there. This could be about 300 odd pips. Is anybody in it? I'm not hearing allulations. Nobody is. Nobody seems to be happy.
I'm in.
Almost 300. The profit potential out of this one should be about 3 pips, 300. Yeah, about 300 pips. Right. So we are in it to win it. We will continue holding this one. Our gold is not yet there. We had sell in 630. We haven't been there. I think gold has been ranging. I'm using a touchpad here. Let me figure out. Gold has been ranging. Let me just quickly check on the other side. Gold. Where are you? 2607. That's where we are. Those cells are at what price? 2600, right? Between 2600 and 2595. That's where we've got those those buy limits. That's where we want to buy it. Right. So we're not quite there yet. For the better part of the day, gold has been a little choppy. Not really. It's keeping a very tight range. Let me put it that way. But it is slowly moving to our preferred buy zone of 2600. Let's see if we can get there. Right. Any other question? Let us see. So nice and clear, right? We know and understand how to engage that CPI data. I did ask, what is the difference between seasonal and cyclical trends? Did we get a chance to do that research? The difference between seasonal and cyclical. Were we too tired?
I did.
Too busy.
I did, but I don't know how to explain it like a human being.
My own understanding, what I got from it was
Yeah.
seasonal. We kind of talk about what happened when we talk about the likes of June, July, August.
Yeah.
That's what seasonal trends kind of have to do. But for cyclical, it kind of has to do with what price does, what market does at certain prices, over and over again, setting support and resistance. So that's what I was able to get from it in a way.
Okay. I won't take anything away from that. Azania, you can, if you can,
Okay, I'll try.
try it as a man.
Okay, for cyclical, what I'm understanding is that it's like how the market fluctuates. So whether we're in a peak, a recession, or the market is recovering.
Yeah.
So those are the ebbs and flows of the market.
Yeah.
And when it happens that's where I don't know when it happens. I think it's because it's affected by many things.
Yeah. But you're very
Yeah, it's affected. See, it needs to be explained by someone who has experience. Because
no, you
when
yeah.
yeah, and then with seasonal trends, like the gentleman before said, those are I don't want to say predictable changes, but that's what Google and ChatGPT said.
Yeah.
But
Yeah.
predictable patterns that are in the market that occur at a certain time of the year. So like with each fiscal.
Yeah.
And they're influenced by economic cycles, holidays, weather. So like the lady asked yesterday about the hurricanes in America.
Yeah.
So I'm assuming that would affect the market somehow, or
Yes.
business activities.
Yes.
This happens, it says the time of year influences currency. So January we may see more volatility. Um, because everybody's coming back to work, everybody's planning their new financial years, etc. That's how I understood it.
Yeah. No,
And then, yeah, it goes on and on and on. And then I just got I'm gonna just ask you to
simplify,
unpack it a bit more.
Yeah. No, your research was definitely spot on. I think you found yourself opening a can of worms. You were like, oh, okay, this is
Yeah, I was like, oh my God, this is so much English.
You didn't have enough English bundles.
Yeah, I was like, oh my God, learn it for English in a higher grade.
No, you're very warm. In fact, I would say your research is very spot on. I'm going to oversimplify cyclical and seasonal trends. So, excuse the background noise. So, seasonal, like you said, can be predictable. And if there's anything to add on to your research, guys, is that seasonal is short term, cyclical, long term, right? Seasonal, short term, cyclical can be long term, right? So we've made examples of seasonal, okay? Seasonal can be a quarter, can be a week, it can be a month. It's seasonal, right? As we know, seasons don't last for a long time. They come and go. Cyclical can be longer, right? But yeah, there are various examples of cyclical trends. But the one which is common and I've used of tracked for the longest time is the presidential cycle. Ever heard of the presidential cycle?
No.
No.
Okay. This presidential cycle, I guess it kind of works. I haven't really studied for other countries, including South Africa. The one that I really follow is the US presidential cycle. Let's talk about, before we get to the US presidential cycle, which is going to make us a lot of money in the future. Let's talk about the South African one, right? So we know that every 5 years, is it every 5 years? Every 5 years we go to the polls to go and vote, right? Yeah, I think it's every 5 years in South Africa. Yeah, it's 5. So I'm sure you've noticed, and it would go for any country. You would notice that the last year leading up to the elections, the change that you've been longing for kind of happens to a certain degree anyway, right? That pothole that has been an eyesore for the last 2 years, all of a sudden, right? The traffic lights, they start to work.
No.
Street lights, the service delivery starts to roll out. Okay, this is basically, and we all know now. We are quite conscious. We understand now that they're trying to get us, right? We are not that gullible anymore. But that's what they do, right? Because if they do it 2-3 years before, we will shift our focus on other things. We will forget what they've done. So they leave it for the last minute, right? So that we remember it. And so what it does, it brings about some sort of sense of, there goes the English again, it's gone. But confidence, I guess, in the current government, that they're doing things that they need to be doing, right? And it brings about not only confidence in us as voters, but also for potential investors or anybody who wants to invest in the economy. Because now all of a sudden there is a road network that leads to such and such a place. And you can now see the value in setting up a mall there because there's infrastructure to support your business in that location. You follow? So now with them, so that can also translate to a positive, I guess, capital flow into the country, right? Capital inflows, money spilling into the country, right? It brings about some confidence. Now, the US presidential cycle is the same thing, sure. They take it a little step further, government is responsible for fiscal policy, which is basically what we've been talking about, which is, infrastructure, social services, healthcare, all of that stuff, right? Falls under fiscal policy. And then we've got, of course, the central bank, the Fed, who's responsible for monetary policy. So under fiscal policy, anyway, we have also taxes, right? So what they will do, they will implement an expansionary fiscal policy. So they won't be as strict on certain business practices, and they might also, relax certain tax laws, right? And say, okay, if your business has got a turnover of X amount of money, you're not, liable for tax, or we are reducing the tax on X, Y, and Z, or we are not going to increase taxes for this particular period of time, right? So, of course, that brings about a lot of confidence. Businesses then will feel much more confident and expand and reinvest, right, in the US economy. On the other end, with central banks, they too can, bring about confidence about the economy by using an expansionary monetary policy, which is lowering those interest rates, and so on and so forth, using various monetary policy tools at their disposal to bring about liquidity into the market, right? So we tend to see that synchronized, effort by both government and central banks leading up to the US presidential elections. And now what I've observed over time is that they start doing this at least 2 years before the elections, or 2 years, the last 2 years, because they vote every 4 years in the US. So every 4 years, presidential elections, right? So it's one of those cycles that you want to never forget about, because it's arguably the easiest investment or trade that you can ever take. I took a break, I think 2018, in the better part of 19, from, coaching on trading. But when I did come back, it was early, I think, or late 2019, early 2020. And a lot of the traders that I coached then, I said to them, this is the last year, or 2020 would have been the last year, of course, leading up to the elections. Well, the elections were in 2020 November. So they were left with a couple of months to enjoy that bullish momentum. So in other words, you're going to see the stock market being bullish the last 2 years leading up to the elections, right? 2020 is when they had those elections. Let's see, where is my, all right, give me a second. Let me just figure out my knife here. I forgot to put batteries into my house. There we go. So I want us to go, let's go to a weekly time frame here. And the best 2020, I must say, was one of the best trading years that I had. And it wasn't just me, it was a lot of traders as well. Even one who she actually texted me. I forgot to respond to her. I'm just trying to remember. Ooh, it'll come back to me. I think it's Tumi, her name. And she said, I'm just gonna go with it, and I'm gonna definitely just open this trade, and I'm not gonna panic about it. I'm just gonna let it run, and I'm gonna put quite a substantial amount of money. And I was hesitant in asking her what a substantial amount of money is. I asked this lady how much she's betting on the cycle that I've just educated her on. But clearly it was a substantial amount of money, because I think it was a year later, I bumped into her, and yeah, driving a rather very nice Bentley Bentayga, and just bought a house in Copper. is a copper leaf, I think it's called in Centurion, copper leaf. And she was saying, hey, listen, you gotta come and see my house. You see, it paid off. So so yeah, those are the type of trades that you can trade with a clear sense of understanding where the market or what the market is doing, right? The last 2 years would have been 2018, no, would have been 2019 and 2020, right? So you can see 2019 picks up pace. We definitely have an interruption here. What happens in this instance here in 2020? Is the
Do
line
you mean
still
what
clear?
happened?
Yeah, what happened in 2020 at the start of the
Wasn't
year?
it COVID?
COVID happened, right? COVID
Yeah.
happened. And as a result of COVID happening, we have this, basically the markets crash. Although this time around, the crash wasn't as severe as the previous one, which was the 2008, 2009 financial market crisis. And that's why you don't hear actually this 2020 financial crash being referred to as a crisis, because it didn't quite feel like a crisis. The central bank, the Fed, this time around, really came to the rescue very quickly, right? And propped up the markets. So we have, I would call, a flash crash, because it literally, as we see that dip early in Feb, and by the end of March, the market it does a V-shaped recovery. And if you actually click on Google and say V-shaped recovery, this is what they're talking about. That's what they coined it, the V-shaped recovery, to zero, to zero, basically near zero, and actually using other monetary policy tools to bring about a lot of liquidity. So this is the year 2020 where those elections were happening in November, and as you can see, November on its own, September, October, November, boom. And I did say you want to consolidate those positions in November. As you can see, the month of November, we go sideways, and then we start to correct. No, I lie. 2020 September, this is it here. This is where it's November. Yeah. So we consolidate. Let me put where's my vertical line? There we go. Let me get my vertical line, 2020 November. Boom. I'm going to put it December there. So what I said to them, consolidate your positions come November. You don't want to be part of that uncertainty, as the US population is at the pulse. So we can see we definitely do peak, and then eventually we break out. Okay. So it was arguably a fantastic year, 2019, 2020. So those last 2 years will always play out. Well, let me not say always. They have a tendency of being very bullish for the stock market. Ne? I hope you're hearing me.
Yeah.
Yeah.
2019, 2020, 2 years. It's bullish. And I even made an example then, and I said, if you have $100 account, one position 0.01, I mean, I think you can do the maths. You would have enjoyed exponential returns. And naturally, anyway, you wouldn't want to just hold one trade. You will likely compound on your trades. So you can literally move 100. And of course, you need to exercise patience. So you can move your $100 account to what? 10,000, maybe even more. It's been done before. Plenty of times. Right? So we voted in 2020. And then now they're voting again this year. This is 2024. So already from last year, the year 2023 and 2024, we've been actually technically been bullish and riding this wave since 2022 October. 2022 October, where are you? There we go. As you can see where we are. Regardless of high interest rates, because remember, central banks started hiking interest rates from 2022. At the start of 2022, they hike interest rates, pushing them up all the way to 5.5%. Sharp. The market reacts to that. Remember I said, the initial reaction may be bearish. I think, did I say it to this group yesterday? I think I did. The initial reaction may be bearish, but interest rate don't necessarily change the direction of the stock market. They simply take away the liquidity, the speed of things. Was it you guys? I'm sure it is.
Mm,
Mm-mm.
Ah,
mm-mm.
you
I
lie.
don't know.
I'm gonna go listen to my own recording. I could have sworn I said it to you. Let's put money on
You
this
can
one.
go.
Money on this one. $100. Who says I didn't say it? You know, I even dream about these sessions. That's how I am about. I want to make sure that you know what I know. So I could have sworn was maybe it was in my dream. Hey, let me not. Okay, let's not. Maybe it was in the dream. Maybe it was in real life. So yeah, interest rates don't necessarily change the direction of the market. All it does is it regulates the liquidity, right? So hiking of interest rates, it takes away that liquidity. Remember, there's somebody out there who has, when we have low interest rates, because this liquidity, this momentum was brought about by liquidity, okay? Because you can look at the years before that. It has arguably been bullish, but the speed of things was not the same as 2020. How do we know that? The candlestick formation more pronounced. They get bigger. That is the momentum. That is liquidity. This liquidity is because of low interest rates. Interest rates get dropped to almost zero, 0.25. Let's quickly go there. Let's look at the interest rates out of the US in 2020. They dropped them to 0.25. Right? And so this brought about a lot of liquidity. Remember, I said that's cheap money. Households will take this money to go and spend it. We're always concerned about spending. But smart money, they're going to take that money, pump it into some sort of vehicle, investment vehicle, make exponential returns, go pay their loan. Right? And this becomes in inverted commas, what they would say, it's a risk-free trade. Right? A risk-free trade is what they would say. Why's this thing stuck? Okay. Interest rates. Let's click on interest rates. We're going to go back to 2020 and see those interest rates. So you can visually see those cuts happening or reductions. Just waiting for that graph to load up. Hopefully today. Okay, let's go 5 years. 5 years is enough. 2020, December, as you can see, December 2019, 1.75. And as you can see, we get the first drop. I think it's March or March. By March, we're already sitting at 0.25. And that stayed that low up until 2022. Remember, I said 2022, they now changed the stance. They're no longer being accommodative. They are now becoming restrictive. The economic wheel at this point, 2022, is it's moving rather fast. Things are getting out of hand. Inflation is double digits. Everybody's got money. So as you can see, they start aggressively hiking those interest rates from almost 0 to 5.5%. And we stay within those high interest rates for the last hike was in May last year, right? And we stay high up until a year later, then we get the first cut, right? So that cycle, this bullish cycle happens regardless of that high interest rate. It was a concern for me this time around because I have never traded in these type of conditions where we are coming from double digits inflation. It was my first time in my entire trading history seeing such, an economic setup basically. And so normally what I'm used to, like I said, is the central bank is likely going to be accommodative, right? In in these 2 years leading up to the elections. But then I wasn't expecting the central bank to lower those interest rates because, well, they still have quite a big fight to win on inflation. So I did question if we were going to see this move. But based on historical data, I studied it and I looked at other times, right? And we could see that we have been seeing the same tendency, this bullish tendency, regardless of the interest rates being high or low. And that's exactly what we saw. So the last quarter of 2022, we were in it. Right? So this move, it's October now, October, November. I guess a month and a couple of, maybe that's a month and 2 weeks, right? A month and 2 weeks still to go. But that train has pretty much left without you, unfortunately. Right? That train, unfortunately, has left without you. But the train always comes back. You may think 20, what is it? We're in 2024, 2020. The next election is 2028. Am I right? 2024, 2028. So you might think 2027 is far. It's it's not. Time flies. Before you know it, it's 2027. Right? And hopefully you'll remember that, oh, it's that bullish cycle again. We are going to have many. I'm not saying this bullish cycle is done and we're going to sell till that time. No. What I'm saying is your easy trade or your opportunity to take advantage of that easy trade will definitely be in 2027, where you can just trade with very little worry because you understand what's going on. You understand that the presidential cycle is back, right? And so this is where you buy your Nasdaq, you buy your Dow Jones, you buy your S&P 500 and hold. Any question?
What do you mean buy and hold level?
Literally open the position, let the sucker run. Let that thing run.
Okay. Okay.
Right? Personally, for me, I can't let my trades run that to, I always have to consolidate. I can't let those accounts run beyond, say, 100,000. Not rands. That's, I'm talking USD, because I don't want the broker to say they can't pay me. Because I've had too many cases like that. And I don't have it in me again to take anybody to court. Like I said, remember I told you, Alenti Capital, that went down. ACM Gold, that went down. Yeah, the only guys I didn't take to court is XM, right? But they played me dirty as well. But years later, we managed to rebuild that relationship, and I used them. Yeah, sure. But I would never I would never let my account get out of hand in terms of growth, right? There is one broker that I would, which I actually have before in the past, have let accounts, get quite substantially big, and that is Swiss Code. I don't know if anybody has heard of Swiss Code. So Swiss Code is in Geneva. It's basically a bank, and they've got a lot of services that they offer on a need-to-know basis, right? So, for example, they can mail you a prepaid credit card. So I can literally just withdraw my funds into their credit card. So basically, I'll have a bank account. That's it. Well, that's what I have, right? And then I get to below the radar to a certain degree because, well, the taxmen, eventually will catch up. But then, this is one of the legal matters that I've been fighting with them since August 2017. Because it's a question of, because there's a law that they passed, right? So you need to declare whatever offshore assets that you have. Now, not many people who have offshore assets do declare, right? So for me, it's if you're going to, freeze my accounts, which is that preservation order that they hit me with, on suspicion that I have an offshore or I have offshore assets, then you need to find them first. Go and find them, and then I'll pay the fine. I'm not going to openly admit, right? So but these codes, they help you. Of course, because I'm trying not to declare as much tax as I can, right? So, well, there's tax avoidance and there's tax avoidance and there's tax evasion. You just don't know which one is legal. So that's all I can say to you guys, right? So I love Swiss Code for that reason. They've got a lot of services, that can really help you out. And I mean, their accounts, I think minimum deposit $5,000. So it is a little steep, right? It's a little steep, but I think once you become a little bit experienced and you've grown your capital, you can shift, some of your funds to such accounts like Swiss Code, and enjoy the benefits, right? It's like private wealth of some sort, if I can put it that way. So yeah, for any other
I
regular,
have a question.
yeah, go ahead.
Just a small question. Can you rename the US stocks so I can have a look that you said we should keep an eye out for a bullish movement in the
Okay.
next 3 years? You said S&P, NAS 100,
Yeah, and Dow Jones and Dow Jones.
and Dow Jones. Okay, cool.
These are the ones that you can just go crazy on and make some decent bucks, right?
Now, when you say hold, is this holding for the full year, or are we holding month by month or week by week?
Fantastic question. So your question is very similar to Medino's one. So I would say at most month to month. Consolidate, open a position, consolidate, close, reopen. So you're taking, you give yourself an opportunity. So you don't have a large floating P&L. So you just close that position, take those funds, well, some of them anyway, a big chunk of the profit, take it out of the broker's account completely, right? Now, of course, now once you do so, you will be liable for tax, right? Because that money now is going into your bank account, but that's fine. Rather have that money in your physical bank account and be taxed than leave it with a broker that can, at any given point in time, say they've gone under. You will definitely lose your braids if you have braids. Because you're thinking you have a lot of money, you're seeing 2 million, whatever, in your account, but it's not in your physical account. It's with your broker. And once they say they're under, well, there goes your net worth. It goes with it.
Yeah.
That's
what is the tax rate for trading? Is it what, 20% or is it 40?
It can be up to 40.
Okay. Depending on how much.
Yeah,
Okay.
depending on how much and your age, right? But of course, if you the tax implications are different for a company, right? So
Yes.
maybe set up, I would say do some little research on that. I've got somebody who does that for me. who's a tax practitioner. So, yeah, the tax implications are much different. And then, of course, I have to pay myself a salary, and that too has got its own tax implications. So I pay myself a salary. I've got to pay pay towards my what's that, PAYE?
Yeah,
Yeah,
income tax.
yeah, and what's that other one? Um, Shucks, I forget it. But the unemployment insurance, basically, right? What do we call it? UIF. So I pay myself towards that as well. So I'm an employee
Hmm.
of the company. So that's how we've got it structured. I'm not the best at advising on those, but there are people who can help you out, right? And I love this because we live in a day and age where access to information is just so easy. I mean, you know how many things we've just learned randomly on TikTok. There are a lot of there's accountants, there's this, there's that. So you get a lot of light bulb moments and you start doing some research, and some of these guys actually do offer their services professionally, and you can pay a premium for that, and not much as well. So yeah, do your research on that, guys. Yo, I did say the power is gonna go out in what, 8 minutes time. So is this presidential cycle nice and clear? What?
Very clear.
Done. So I hope to see you in the Maldives then in 20 at the end of right? Stepping on something. If you're not there, Shema, yeah, I'm writing you off. I so let us meet there, guys. Right? Yeah, let us definitely meet there. If the Maldives doesn't work out, then at least um just around the corner here in Tanzania. Beautiful. What's that place? Those, let's see, that island. You know it very well, man. It's white beaches. It's beautiful in Tanzania there. The plan was to go there this year, but the time doesn't allow. It's not expensive at all, so it would be nice to see traders there, right? Maybe that one we should set up for 2 years from now, so that will be 2026, right?
Agreed.
For that, it's absolutely
Awesome.
beautiful. Yeah. So the plan was also to talk about, like I said, to continue on that monetary policy reports, but we need time for that. We need time for that. So if there's anything, let me go into Forex, my FX book, to just show you what my automated trading journal looks like, right? And then I guess in the next session, not necessarily tomorrow, but I'll show you in the near future how to set it up for yourself. I think some might, uh, be a little ahead and actually just do their own research and find out how to set it up. But I will have it takes about 30 minutes to show you how to set that up. In fact, less. 30 minutes is a lot. So my FX book is, I don't know what type of site, I don't know what to call this type of site, but it has a lot of things. It's got your economic calendar, these brokers, where they review them. We've got news as well, but I don't use it for most of these things. I discovered this, I think, 7, 8 years ago. This automated trading journal, right? So that's what I use it for. Let me just quickly sign in and show you what it looks like. Because before this, I would keep an Excel spreadsheet. So I have to journal everything. What time was the trade executed? What time did I close it? What was I trading? What is, man, and I don't have that time. Well, I'm not, maybe, let me just say I don't have the time. I'm not disciplined enough to just follow through on such every day capturing this data to do so, because then you get, to review this data and constructively criticize yourself. So you need to have, some sort of ledger to look back on. So yeah, this one is that account that I opened back in June. Was it June? July, August. I think it was June. Let's have a look, see on it. The last update on this was the 11th of September. I'll try and get the latest update. Well, I did actually do this. When did I open this account? I'll tell you. It should tell me. Oh yeah, it'll. Yeah, June the 18th. June the 18th. Right. So I funded the account $2,000, grew the account to $52,000, and then yeah, like I said, they got a little out of hand, so I decided let's consolidate this one. So 3.5 months trading this account, and the reason why I'm showing you this is that you can see that, which is a lot of traders won't show you their losses. Everybody just wants to show you the good side of it. So there are losses, and some quite substantial on other days when I don't follow my own rules on risk management. But nevertheless, with any account, be it you've got 20, 30 years experience, it won't just be a straight line to the upside. A good push on this account. In terms of growth, 1,004, no, 2,000 on this account, right? 2,127% growth. On a daily, I was averaging 2.7. Now, you see, 2.7% sounds small to many traders, especially with, I would say, small accounts, right? Because 2.7% of $100, how much is that? Right. So you start to think, no, it's not worth it. But I always say, I mean, yeah, it can be a little bit more, right? It can be, but it will speak to your risk appetite and the type of trader that you are. But on this particular account, the average is 2.7%. And traders, this is where you need to learn to exercise patience, right? Because even if it's 5% or 10%, you're still not happy with that. What you want to do is 200% per day. You want to take your $100 account to $400 in the same day. It's possible, yes, sure. But you won't average that. You may hit that on random days, okay? But it's money attracts money. I mean, that's one of the reasons why we are blowing accounts, and it erodes your confidence. You start to question whether you understand trading, and in most cases, that's not the question. The problem lies in risk management. You fully understand where the market is supposed to be going or where it's going, but you lack the patience to wait for the setup to play out, and you take on a little too much risk, and so you get you blow your accounts prematurely, right? So monthly 185%. I mean, even if it's 5% monthly, there is no investment firm out there that's going to offer me that monthly. Yearly, annually, yeah, sure, maybe, right? But most won't even give you more than 15% annually, honestly. Put your money here, leave it with us. For the year, we'll give you, nah, it's nah. The most I've gotten from Investec was 18, and that was lousy, right? Because you start to question, is it worth saving your money there? Because you rather put it to work in other investment vehicles, which might yield exponential returns, right? Because, well, that's what they're going to do with your money, but the only one I'll offer you 18%. So if you can, have that type of consistency, you're definitely going somewhere, right? You're definitely going somewhere. And like I always say, trading doesn't have to be your passion. For most of us, it's not. It just makes financial sense. We've got passions that we want to pursue, but we lack the capital. So this is where we're trying to raise capital through trading in financial markets. And we can redirect the funds to our passions, right? And in fact, that's what you should be doing anyway. What's the term? Diversifying your portfolio, right? Yeah. Any question?
No,
Oh,
not from me.
All righty. Yeah, any moment from now is gonna be pitch black on my side, but I'll quickly wrap it up. So amount of trades that I've taken so far, 358, as you can see, 70% shots, 49%. My best trade being $10,000, worst trade being $2,000. In terms of pips, it would have been 20,000 pips. on that trade. West trade in terms of pips would have been 38,000 pips lost. I would average 900 pips per trade. And there's just so much to see on this. As you can see, June, July, August, September. If I click on them for that particular month, June, gold being my favorite, makes up most of those trades, 36%, followed by, let's see, equally USD, JPY, and Bitcoin at that time, and Euro USD and GBP USD, that's equal. And then everything else, I've got Nasdaq here, 6.7%, GBP, JPY, and you get to see sells, and yeah, USD CAD, I was buying mostly.